In this chapter, we look at some other tools that are available to organizations to control transaction risk, particularly those that use the currency markets, that use derivatives. So we've already looked at derivatives in outline, how they work, what they're all about, how they operate, and particularly in relation to commodities. What we're going to do now is apply exactly the same concept to currencies. So we will look at currency futures. Now, currency futures are exactly the same as any other type of future, commodity or interest rate futures. They are standardized contracts that you enter into to buy or sell a set amount of a certain quantity of currency, in this case, at a certain time. So exactly the same as commodity futures. And like commodity futures, you enter into a futures transaction for our purposes in order to neutralize risk. So you're trying to reduce the transaction risk that you face by entering into a futures transaction. Now, where currency futures are a little bit more involved than other types of futures is that by definition, when you trade currencies, you are buying one currency and selling another. So whereas with cocoa beans, it's pretty easy to figure out, are you buying the cocoa beans or selling the cocoa beans? With currencies, you've got to be a little bit careful about which currency you're dealing with. So we'll look at that, and we'll look at how that works out in practice. We'll also look at currency options, which actually in terms of the calculations are much simpler than currency futures, because you simply decide whether or not you're going to go through with the option, whether you're going to exercise your option, and then do a quick currency calculation. Now, like all other types of options, what currency options do is they protect you from the downside. So if the currency rates move against you, it offers you some protection, but you get to keep the upside. So if the currency rates move in your favor, you will keep the benefit from that. And options allow you to do this, which other types of derivatives and other hedging tools don't. Now, in exchange for this, you do have to pay a premium. Again, as with all options, you're going to have to pay someone to take the risk for you. So the best way to think about this is a bit like your insurance, paying premium on your insurance. You pay the premium, it gives you protection. If you don't need the protection, as it turns out, you don't make any claims, then you've still got to pay the premium. But it does mean that your losses are at least limited. And then finally, we'll look at currency swaps that are very similar in idea to interest rate swaps, but instead of swapping different types of interest rates, instead of swapping fixed and floating interest rates, we're swapping debt in two different currencies. So they are a nice, quick and easy way of exchanging your debt from one currency into another, and we'll see how that can serve to reduce the overall currency risk you're taking, particularly if, for example, you're investing overseas. So let's look first at currency futures. Now, as you'll recall, futures are an agreement to buy and sell something at a fixed price at a fixed date in the future. But the big difference between futures and forward contracts is that futures are tradable. And that means that the way you use them is that you will enter into a futures transaction on top of your underlying transaction, and that allows you to reduce the risk. Now, what can get a little bit confusing with currency futures is working out whether you are buying or selling. Because by definition, with any currency transaction, you buy one currency and you sell another. That means you have to pay attention to what the contract currency is, and that will be given in any question. You've got to look out for which currency is the currency of the contract. If you buy the futures contract, you are receiving the currency that the contract is denominated in. If you sell the futures contract, you are supplying, you're selling the currency contract. And that means you're supplying whichever currency it's denominated in. And as we'll see, transactions must be for a whole number of contracts, which does limit their flexibility a bit in terms of covering off your risk. The key advantages and disadvantages of using futures as opposed to other methods of managing transaction risk. Well, the date can be a little bit flexible. If you remember, you can close out a futures contract at any time up until when it expires. So you can close out your futures contract whenever you receive your money in foreign currency or whenever you have to pay your money in foreign currency. Futures are traded on a regulated market. And that means there is protection for all participants, and in particular, you don't have counterparty risk. The way that an exchange protects participants against counterparty risk is that in order to trade on a futures exchange, you need to deposit something called margin with the exchange, and margin is basically a cash deposit. So if I want to trade on a futures exchange, I will need to make a margin deposit. The amount of that deposit will be determined by how much I'm trading and whether I look like I'm making a loss or not. What that means is, if I then go bust and I have some positions which are loss-making, the exchange will take that margin and use it to cover those positions, use it to pay back anyone who's traded with me. What that means is, as a participant in the market, I don't have to worry about anyone else defaulting on me. I know that I'm going to get settlement for my money. This is different to, for example, a forward contract where my deal is just with the bank, and if the bank goes bust, the deal's off. The futures market is highly liquid. There are lots and lots of participants. There's lots of trading going on all the time, so it's very, very easy to buy and sell at any given time. Some of the downsides, well, the contracts, as we've seen, must be in whole numbers. So you can't tailor them to exactly your needs. Now again, this is different to a forward. A forward can be for precisely the amount of money you need, whereas a future can't. There are only a small number of currencies traded in currency futures. Basically, it's limited to dollar, euro, sterling, and yen. Those currencies can be traded against each other in the futures market, but other currencies can't. So if you want to deal in different currencies, you need to use another method. If you're going to trade futures, you need a broker. You need someone to actually trade for you in the market, and they need a fee. And as we've seen, you need to maintain a margin account. And although that protects everyone from the risk of default, what it does mean is that there is a cash flow issue. If you want to trade futures, you need to make a cash deposit with the exchange, and you need to find that cash from somewhere. So again, that's a downside compared with some other methods. So to see how futures work in practice, we'll work through a mini scenario and see what calculations are involved. Now these calculations are examinable. You could be asked to do this sort of thing in the exam. It may seem a bit confusing at first, but if you practice a few, you will find they're quite straightforward, and the number of calculations involved in this is actually quite few. So we have a mini scenario where a UK company owes an American supplier $950,000. So they've imported something from the US, they've now got a payable. It's payable on the 31st of August. So what's our risk? Well, our risk is that in the time between now, 31st of May, and the 31st of August, that the dollar appreciates and that sterling depreciates. Because if the dollar appreciates and sterling depreciates, it means that that $950,000 is going to cost us more in sterling than we're anticipating, and we'll make a loss. So what can we do about that? Well, one thing we could do is use futures. And we're given a little bit of data about the futures markets. There are sterling dollar futures contracts available. They're only available in a limited number of currencies. So you'll generally see sterling dollar, euro dollar, or yen dollar. And each of those contracts are tradable in units of £62,500. Remember, futures contracts are standard instruments, so they have to be a fixed amount. And we're told there are contracts expiring in June and September. We're also given the current spot rate, and then we're given some data about the situation in August. What we need to do is set up the hedge and work out what the outcome is. So, taking this step by step, the first decision we need to make is which contract we're going to use. Well, we're going to be making our payment in August, so there's no good using the June contract because that will already have expired by the time we reach August, and we won't have any cover. So we're going to go for the September contract because that will still be in place at the end of August. So which contract are we going to use? We're going to use the September contract. Next, we need to decide, are we going to buy or sell the contract? Now the contract, remember, is denominated in units of £62,500, so the contract is in sterling. What we're worried about is that the dollar appreciates and sterling depreciates. So what we're trying to do with futures is effectively make a bet that sterling will depreciate. Because if we make a bet that sterling will depreciate, and it does, we're going to win our bet and we're going to get a payback. The amount we will win on our bet will hopefully more or less offset the loss that we'll make on our transaction. If, on the other hand, sterling appreciates, sterling goes up, we're going to lose our bet, we're going to have to pay out on our futures transaction, but we will gain on our underlying transaction the payment we're making to our American supplier. So we're looking for something that's going to offset our exposure. That's why it was so important to clarify what our risk was. Well, if we're worried about sterling depreciating, we need to make a bet that will pay off if sterling does depreciate. The contract is in sterling, so we want to sell the contract. Because if we sell the contract at a certain price and sterling depreciates, then we will be able to buy it back again more cheaply later on. If we can buy something cheaply and sell it more expensively, we will make money. If we were worried about sterling appreciating, then we would want to buy the contract. So in this case, we want to sell the contract. How many contracts do we want to sell? Well, we want to sell enough to more or less offset our exposure of $950,000. We're going to use, to convert that $950,000 into sterling, we're going to use the futures rate because that's the rate we are committing to sell at. So we're going to divide our $950,000 by 1.4214 to convert it into sterling. That gives us £668,355. How many contracts is that equivalent to? Well, if we divide 668,355 by the amount of the contract, which is 62,500, that gives us 10.69. You'll remember that futures contracts are only tradable in whole amounts, so we can't trade 0.69 of a contract. So what we're going to have to do is round that to the nearest whole number, say 11. This is what we'll always do. We'll always want to get the closest possible match, so we're always going to round it either up or down to the nearest whole number. So we're going to sell our 11 contracts. What's the outcome of that? Well, the opening futures price that we sell at, remember, is 1.4214. Fast forward then to August, and we make our payments to our supplier, and we want to now buy 11 contracts in order to close our position. So we're going to buy 11 contracts at whatever the price is at the time. Well, the futures price at the end of August is $1.3339 to the pound. So we are buying at 1.3339. What that means is that the movement in the price, quoted in terms of dollars per pound, is 0.0875. In other words, there's a difference of 8.75 cents per pound. And what we've done here is that we have sold at a high price and we have bought at a lower price. So we have made a gain. We have bought more cheaply than we sold. So we made a gain of 0.0875 dollars per pound that we were dealing with. So in order to work out our total gain in money, we need to multiply that by the value of the contract, which is £62,500. So multiplying that gives us a gain per contract of $5,468.75 per contract. So to work out our total gain, we'll need to multiply that by 11, which is the total number of contracts we were dealing with, gives us a gain of $60,156,000.25. So what's happened here is that our bet has paid off. We made a bet that sterling would depreciate, and it has. So we've made a gain on our bet, and that is going to offset the loss on our underlying transaction. So what are the overall cash flows? Well, we're going to want to pay our supplier the $950,000. But we can offset against that the gain on our futures transaction, which is $60,156.25. That is going to give us a total cost of, let's call it, $889,844. What we're going to then have to do is go and buy those dollars in the spot market. We're going to sell sterling to buy dollars. Now we're given the rate, and this is a chance to practice working out which rate to use. So we are out there buying dollars, selling pounds. We go to the bank and say, I'd like to buy dollars. Will the bank sell us $1.3328 for each of our pounds, or will they sell us $1.3408 for each of our pounds? Well, remember, the bank always wins, so they are going to give us fewer dollars. They are going to give us $1.3328 for each of our pounds. So we buy our necessary dollars at a rate of 1.3328. So this is going to cost us £667,650. So we've made a gain on our futures contract, our bet has paid off if you like, but on the other hand we've made a loss on our transaction because those dollars are now more expensive than they would have been at the start of the transaction. Now, as well as futures, it's possible to use currency options to manage transaction risk. And remember what an option is. It's something that gives you the right but not the obligation to buy or sell something. And the right but not the obligation to buy something is known as a call option, and the right but not the obligation to sell something is known as a put option. Now in this case, what you are buying the right to buy or sell is currency. And as with any other type of option, there will be a premium payable. So what you can do with options, as it spells out here, is you can get to keep some of the upside while protecting yourself against the downside. So let's see how options could work in practice by putting some numbers on it in a mini scenario. We've got a company that has sold some goods to the US and is due to receive $20 million on the 30th of June. It's now the 1st of April. Now in this situation you have transaction risk. The risk is that the dollar depreciates. And that means that the $20 million you're receiving aren't going to be worth as much as you're expecting they would be worth in sterling. Now what you can do is buy a put option for dollars, so an option to sell dollars at a rate of $1.55 to the pound. That gives you protection against a really dramatic fall in the dollar. So what's the outcome, assuming that we go for that option and then the spot rate on the 30th of June is $1.5723 to the pound? Well, if we exercise the option, then we sell our $20 million at a rate of 1.55, and that means we will receive £12,903,000. If we don't exercise the option, then we will sell those $20 million at the spot rate, which is 1.5723. So if we sell our $20 million at 1.5723, we will receive £12,720,000. In other words, in this situation, we are going to exercise the option, because that's better for us. Now do bear in mind that in these types of situations, the premium is a sunk cost. So we have already paid our premium up front, and this now has no bearing at all on whether we choose to exercise our option or not. Incidentally, we would have had to pay that premium on the 1st of April, so that would have cost us $200,000, bought in the spot market at a rate of 1.47, so there would have been a cost of £136,054. And whether or not we exercise the option, we are going to have to pay that. So as we've already mentioned, currency swaps allow organizations to exchange their debt from one currency into another, and like interest rate swaps, they offer a cheap and easy way of doing so. They do this, you change your debt from one currency to another by exchanging your debt with someone else. So like interest rate swaps, quick and easy, but they do have counterparty risk, and there may be costs involved if perhaps you're using a broker or some other type of middleman. Let's go through an example, just a simple numerical example to demonstrate how these tools can work. So we've got a situation where we've got company A based in the UK and has borrowed £20 million, paying 5% interest. They are going to invest in France. So they're a UK company, they're investing overseas. This opens them up to various types of currency risk, in particular economic risk. The risk in particular is that the value of the euro will decline, and that therefore their investment in France won't generate enough cash to pay their interest of 5%, which is going to be in sterling. So if the euro goes down, they can't actually service their sterling debt. How can they protect themselves against this risk? Well, they have a counterparty who is willing to swap the pounds into euros. In other words, they can exchange their sterling debt for euros. Now, what company A might be able to do, of course, is go to their bank and actually borrow in euros, but there might be situations where they don't want to do that. Maybe they're a small company and the banks aren't really willing to deal with them on this basis. Or perhaps they already have sterling debt and they don't want to refinance it. They want to do something that's quicker and simpler than that. The swap is going to be at a rate of £1 to 1.5 euros, and the interest on the euro debt is 6%, and the swap is going to last 10 years. So how is this going to operate? Well, we'll start off with company A borrowing their £20 million. What they're then going to do is exchange that debt with the counterparty, so they then pay the £20 million over to the counterparty in exchange for 30 million euros. Because remember, the exchange rate in operation is 1.5 euros to the pound, so the £20 million is going to be equivalent to 30 million euros. They then take that 30 million euros and they use it to invest in France. So that will fund their French investment. And remember, that French investment will generate returns in euro. So the issue there, as we've already mentioned, is that if the euro declines against the pound, then these returns may not be enough to pay the interest that they need to pay on their £20 million, because the bank is expecting the interest on that £20 million sterling. So as part of the swap, what company A will then do is they will then pay interest to their counterparty on the euro debt. So they will pay interest on this 30 million euros that they've got from the counterparty at 6%, which is going to be 1.8 million euros. So they pay the 1.8 million euros to the counterparty, and hopefully they will be able to fund that 1.8 million euros out of the revenues that they're earning from their French investment. Now, in exchange, the counterparty will pay A interest on the £20 million that A has swapped into the counterparty. So the counterparty will pay interest at 5% on £20 million. 5% of £20 million is £1 million. So A is going to receive £1 million. What they're going to do with that £1 million is they are going to use it to pay the bank the interest that they owe on the original £20 million debt. So the bank's happy, they get their sterling interest on the sterling debt. And A is able to use their French earnings to pay the 1.8 million euros a year to their counterparty. So this is going to go on for 10 years. It's going to happen every year for the duration of the swap, and at the end of the 10 years, the two parties will re-swap the original amount of the debt. So at the end of the 10 years, A will pay the 30 million euros back to the counterparty, and the counterparty will pay the 20 million pounds back to A. So A now has their 20 million pounds back. What are they going to do with it? They are going to use it to repay their bank the original amount they owed. So they can repay their bank, and in the meantime they've been able to service their debt out of the earnings of their overseas operation. And for that time, if the euro goes up or down against the pound, it doesn't really matter, because the earnings they're getting from their operation are in euros, and the interest that they're having to pay in order to service the debt that financed that operation is also in euros. So they will match each other, and whatever happens to the euro, they will still be able to service that debt. So in this chapter, we've covered three types of derivatives that companies can use to protect themselves against currency risk. We've looked at currency futures and how they work. And remember what futures are all about. They allow you to neutralize risk by entering into a second transaction that balances out your underlying transaction. You can structure your future so that whatever happens to the exchange rate, you're not going to have any losses. Remember, futures are bought and sold on an exchange, which means it's regulated, it's transparent, it reduces counterparty risk, but it does mean there are some additional costs, and it does mean they can be a little bit inflexible. We also looked at currency options. Remember, options give you the right without the obligation to trade at a specific exchange rate. So it gives you protection while allowing you to benefit from the upside, and there is a price for this, which is the premium payable. And then currency swaps, which are an easy way to exchange your debt from one currency to another, and that can allow you to match the interest payments that you need to make with the earnings from the operation that's being funded by that debt.